Welcome everyone to the Kendall Report, where I share my 40 years of experience to help you manage your portfolios and protect your wealth. Don't forget to subscribe, hit that like button, and share these videos. Several weeks ago, I warned you that we're going to see the carnage that is unfolded from this shutdown. We're starting to see this with now over 30 million unemployed and more to come. There's several major states that are still not opening, some saying not until the end of May. If you recall, I said that it would be catastrophic every day past April 15th that we stayed closed. Now we're working into the 4th of May, and every day it is getting worse, but market participants appear to have accepted that the worst is going to happen. This week we will see the unemployment level, which I'm expecting to see it come in somewhere between 12 and 15%. If you recall, just 2 months ago, we were at the lowest level since 1969. Now we've flipped the script completely, and we're not done yet. This level is likely to move toward 18 to 22%, depending on these states that continue to stay closed. Things that we're witnessing occur in some of these states seem to be unheard of in the United States of America. There appears to be a very strong effort to keep many major parts of the economy shut down. I understand the fears of infection, but I also understand the consequences of continuing to keep the economy shut down. Also this week, we'll see the ADP report come in, which is expected to show a minus 21 million. That number doesn't even make sense, but we're going to see some amazing numbers come out of the economy as we walk forward over the next several weeks. While the economic event is far from over, market participants continue to price in what they believe is to be the worst. If you recall, several weeks ago I talked about these unexpected shock waves to come. That's still a possibility. The most likely unexpected event we're going to see once we do get the economy start to open up is how many businesses aren't going to reopen. In spite of the SBA loans and the PPP, it's not likely to have the effect that the government told you it would. In reality, there were about 22 million applications. I'm not sure the exact number, but I believe it's under 5 million have been fulfilled. And everybody that applied needed the money the day before they applied. There will continue to be these massive dislocations of capital, but remember, last week the Fed told us they would backstop virtually everything. The QE program that they're on now is unlimited, and they're going to continue to backstop the markets the best they can. And it appears that market participants have bought into that scenario. In the last several days, we've witnessed some selling come in on the equity side, but nothing material as of yet. You'll see as we go through the technicals tonight, there are major support regions building underneath the market, suggesting that the downside will be limited for now. In spite of the expectations that the equity markets are building in, we're still going to see the carnage in the economy to continue to unfold. There's always the risk of an unexpected event. Let's take a look at the technicals and see what we can uncover for the beginning of this week. Before digging into the charts, I want to review the database. Notice that the equities are now 30.94% bullish, ETFs 23.83%, and mutual funds at 16.2%. It's interesting that the database has continued to get some traction on the intermediate models, specifically in individual equities. Many times in these kind of events, the opportunities lie in individual equities, not in trading mutual funds or ETFs. In spite of this traction we're getting, you can see if I overlay the mouse, there's no real material traction yet in the intermediate database. Looking at the sectors, you'll see some dark green, which says there is some positive rotation coming into these markets. Looking at individual industry groups gives a little better picture. Basic materials seems to be getting some traction, which is a good sign. Aluminum stocks are coming in to the database as new buys. but for the most part, very little rotation until we get down to healthcare, and you'll see healthcare continues to get some traction. Now 70% of the stocks are long into healthcare. From an intermediate standpoint, there's not a lot of possibilities yet. As we reviewed the WaveTech research tool, you'll see that all of the sectors are currently flat. Looking at the daily database or the short-term view, we have 11 of the 12 sectors long, or 91% of the sectors are trending to the upside. 69.61% of the industry groups are trending. 50.1% of the symbols long, or 8,374 of the 16,716 symbols. Looking at the model output for Monday, we saw a substantial amount of selling coming in on the daily model 3.2, as there were 1,520 symbols selling, only 248 buying. We are getting a rotation in the database triggered by the last 3 days selling, so there's a lot of trends breaking down, but there's still a substantial amount hanging in there. We did see the weekly 3.2 model kick in, 231 buys and 30 sells. It's not really material. You'd want to see something over 2,000 sells there. The conclusion, looking at the database, we continue to struggle on intermediate charts coming into play, as a lot of new trends have not emerged as of yet, and the short term continues to see a rotation maintaining about 40 to 60% bullish, which suggests the underlying trend on a short term basis is still positive. We're going to start off with an hourly graph on the S&P futures. They bounced off some significant support around 2772 level. After hitting that support, it traded as high as 2808 and is now pulling back a little bit. And we'll see as the London folks come in about an hour if they start to buy. The last 3 sessions, the Londoners have been the sellers coming into the open of the FTSE. Several sessions ago, I discussed the new Fibonacci numbers that came into play above the markets. They are still valid. You'll see PPM1 has turned up. PPM2 is starting to lose some momentum, but PPM3 continues to maintain some momentum, which tells us that this longer term average, this 40-period moving average, is bottoming out and probably will turn up. We traded up just below the 200-day moving average. We hit that 0.618 number that everybody on the planet's been talking about, and then we backed off of that. But we still have this upward sloping 21-period moving average right here that is driving the support of this market. And we're continuing to look at the futures, as they've given us a much better representation of what to expect from the cash markets in the next session. We're probably going to see at least 2 sessions up. If we close higher today, then that will be a very positive sign. The minimum targets 28.45 to 28.68, and the extremes now are 28.90 to 29.19, which puts us up back toward testing that high that we rendered last week. Major support now under the market, 27.50, 27.17 level. The extreme right now is 26.80. The configuration on the weekly chart continues to suggest that we're likely to see some sort of ABC pattern. Several weeks ago, I was predicting we would come back into this 2400 level, and that's still a possibility. This downward sloping 10-period moving average here will continue to act as a magnet. Right now, it is at 2702. It falls in line with the expectations that I just talked about on the daily chart. Ultimately, we should get this pattern. We just don't know how deep this leg here will be. We should continue in the sideways range. This economic uncertainty is going to keep the markets from running away at this time. So what we're likely to see then is a trading range between that 2650 and 2920 levels set up. I've had a lot of questions from folks talking about the ratios between the small cap and the large cap. And this is a daily spread chart of IJR, which is the small cap ETF, versus SPY. And it looks like we're trying to etch out some kind of bottom. But as we go up the scale and we look at the longer term, we look at the weekly, you get a much different picture. This still shows that at least we've got some stability, but we've seen this happen numerous times in the past. It's most likely if there's going to be a substantial rally in the markets that the small caps are going to have to come into play. The problem is that these are the U.S. companies that have been damaged the most, but there will also be some bargain hunting because of the large cap stocks that have continued to lead the way. We're still seeing a lot of inflows of ETFs, the SPYs and the big major ETFs, but primarily the large cap is still driving the market. Let's take a look at the monthly graph. While the first two charts we looked at looked really encouraging, the monthly graph is still in an outright collapse. We're a long ways from seeing stability in these long-term charts. This will be the place to watch. Last week when we saw the markets moving higher, small caps really kick in. This is what this chart reflects here. And there is overall some positive sentiment starting to build there, which is encouraging for the overall market sentiment. As always, folks, thanks for watching. Don't forget about the live cast on Wednesday at 1:30 Eastern Time. Have a good day trading, and we'll talk to you tomorrow night.